And we tell this to our founders all the time, including people that are pitching us. It's like, if we're seeing 8,000 companies and funding 8, we're not interested in the top 1%. We're interested in the top 1 BIP. Like, we want absolute superstars.
Welcome to Forging the Future, and I'm here with Ben Narasin from Tenacity Venture Capital. Hey, Ben.
How are you? Good to see you, Chris.
Thanks for coming down.
Nice to be in Houston. It's a change of pace for me.
Yeah, that's right. Got you off the coast. So we both have 25 years of experience or more. Who's counting, right? And you actually went to college for entrepreneurship. I don't think I even knew. I've known you for years. I didn't know that. So did you always want to be an entrepreneur?
Oh, yeah. I've been an entrepreneur since I was 12. I had my first job when I was 11. And, you know, it's funny. I remember I was talking to my son once, who's now 26, but this is before he graduated from high school, about his hopes and dreams. And he's like, Dad, I just don't know what I want to do. I was like, yeah, it's hard for me to understand that because I've always known what I wanted to do.
What did you do at 11 years old?
I got a job at a used bookstore that paid me 25 cents an hour in credit. And then I was so proud because I negotiated a raise to 25 cents an hour in cash and 25 cents an hour in credit. And then the next guy they hired, they gave the same deal to. And I'm like, he didn't earn in. What's that about? And that was my first lesson in the lack of meritocracy in a lot of situations. That boss was also a horrific boss and taught me a lot about what not to do as a manager. So it was useful.
Nice. What kind of books were you buying back then?
Well, I was a comic book collector, so I used it as a way to build that inventory.
You were an investor from 11 then.
It's true. My first business was going to Comic-Con with a dealer's table and buying and selling comics. So I ran that business from a $50 loan from my dad up to about a $100,000 inventory of rare comics. It's a great experience. I mean, comics in many ways are similar to commodities or NFTs. You know, there's a lot to learn, but also the fundamental, I mean, you know, entrepreneurship boils down to a certain set of realities. Margin and cash flow are very important. And, you know, that's actually, I remember the moment I decided that I wanted to become an entrepreneur. I didn't know the word for it. I had a comic book in my hand that I was going to buy. Let's call it X-Men number 72. And I said, how much for this comic book? And the guy said, $10. I was like, okay. While I was reaching for my money, another kid walked up with a very similar comic book. Let's call it X-Men 73. And he said, I want to sell you this comic. What will you pay me? And he said, $5. And I said, I am on the wrong side of the table. And that's what I learned about margin and markups. And, you know, it was my dad loaned me $50 and I came home with $1,500 in a paper lunch bag because I had no idea what to do with the money. And so that was the beginning of a very fruitful entrepreneurial career.
And so you went to school for entrepreneurship. Where'd you go, by the way?
So I went to 4 different schools, but I ended up graduating at Babson, which was the original curriculum on entrepreneurship. Interestingly, like me with my son, my father encouraged me to go to Babson from the beginning, and I would not listen to him. So I went to 2 or 3 other schools before I finally got there. It was perfect because not only did they have an entire curriculum on entrepreneurship, but you could start a company and get credit for it. You know, so I was basically able to get a college education while running businesses.
Was that when you started? You had one of the very first e-commerce companies, right, back at the beginning of the internet?
Yeah, that was it. That was later. So when I graduated from Babson, I started a menswear company making stuff sort of like this. And then in 1993, when Berners-Lee created www, I'd already been using the internet. You know, obviously the internet predated the web, and I grew up in a computer family. My dad worked at IBM my whole life. I had one of the first laptops ever made. So, you know, I was using Gopher and Waze and Fibs, the first internet backgammon server where you're literally playing backgammon with people around the world in a text interface. But it was also my first exposure to live chat. Nobody of an age that's grown up around live chat can understand how truly amazing it is that you're sitting in New York City talking to somebody in Yugoslavia back then live, because that was like a $30 phone call. And now you're just like, wow, what time is it there? What's the weather like? You know, like, anyway, so when the web came along, I just believed that was going to be the biggest thing in my lifetime, and I wanted my part of it. So I abandoned a profitable, what I now understand to be called lifestyle business, to bet it all on the risk that I could do something amazing in the web.
And what was that?
So originally, I'll tell you what I wanted to do. I wanted to rent software online. I could have literally invented what was called ASP and is now called SaaS. But I spent a lot of time thinking about it, and I said, you know what? Obviously, Microsoft, IBM, HP, all these people are immediately going to figure this out and kick my butt. So I better do something else. So in the end, I took my existing network and knowledge and created fashionable.com because I could leverage the network I had and protect it because I had domain expertise. Now, that worked out just fine. We took the company public, et cetera, but man, if I had been the first person ever to rent software, because back then you were paying like $300 for Word, right? Even if I shipped you a CD of Word, for $30 for a month, like, it would have been a great business. And by the way, of course, none of those people came around for years.
You could have had first mover there.
Oh, yeah.
But you went public though, right? I mean, you sold your company. What was that like back then? Did you ring the bell? Where did you go? New York Stock Exchange or NASDAQ?
We were NASDAQ, so we had a virtual. They didn't have the fake bell they have today. But it was a great experience. What was interesting, there were some learnings there that have been relevant ever since. But I was one of the first CEOs of a public company to ever have to sign a Sarbanes-Oxley document. I still remember this. There's always those formative moments. My lawyers came in one day and said, "Hey, you need to sign this." I'm like, "What is it?" "It's an attestation of your the accuracy of your accounting documents." I'm like, "I already signed off on the accountant's work." Like, no, this is a different one. This is where you personally attest to the accuracy of everything in your accounting document. I'm like, how would I know? Like, we just paid Arthur Anderson back then $250,000. That's their job. Like, yeah, too bad. If you don't sign it, you get delisted, so you better sign it. I'm like, what if there's an error? That's your problem. I was like, this is terrible. But they also said, but you have no choice. So it was like, this is a learn. And I was like, when did this start? And they were like, yesterday. So anyway, I was talking to somebody at your event actually that had taken their company public on a smaller size round. And I was like, wow, there's a lot of compliance realities and costs. And, back then they were less. Now they're more. But, the reality is as soon as you're a public company, your whole world changes. Everybody's your boss and they want to know about everything you're doing and they want to know why anything went wrong. And of course, it's all your fault. I actually did something novel at the time. It might have been unique. I decided it was really important that all my shareholders hear directly from me what was going on. And I started doing live Ask Me Anything. I think it was either monthly or quarterly online sessions. At the time, Yahoo had the preeminent finance board. So we just did on there, attached to our share symbol, you have questions, I'm here to answer them. And actually, for all the screaming at me offline, they were pretty respectful there because, people are can be less problematic when you're actually talking to them versus when they're posting their random rambles about how everything that's happened here is clearly Ben's fault. Or let's face it, the entire market fell apart, but that didn't matter if you were a shareholder in my company. That's what hurt you. Even if every single company was trading down 90%, which they were.
Well, I don't know about you, but I would like many more of my investments to actually give me an update every month. So I think it's still novel that you were doing it back then. So once you exited, is that when you got a interest in investing? Because you also said you didn't seem to be that interested in accounting, or maybe you weren't exposed to that. But I mean, how did you get from being an entrepreneur to deciding I want to be an investor, or you just had a pile of cash and now what do I do with it, or how did that happen?
I would say it was sort of evolutionary. So we raised money in our IPO off of a profitable business in the bubble. Now, once we had raised that money, we needed to invest it. They didn't give it to me to just sort of have as my own little fun ball of money like SBF seemed to feel all the FTX money was for him. So I ended up, when the world collapsed, buying about a dozen other companies because we had, I've been told, invented the model of cost per click, and most other people were doing CPM and CPA models. And so we bought 12 companies, 11 of which we made money on like in under a quarter, the 12th of which I got a little arrogant and tried to go too far and it didn't work out. But
we call those learning experiences.
Yes, exactly. One of my favorite quotes that I say over and over again to help particularly younger entrepreneurs understand that there's a tremendous difference between intelligence and wisdom. You're born with intelligence. It's like lung capacity. I don't care what you do. The bag's the bag. It can hold a certain amount of air. Wisdom you earn. And my favorite quote around that is experience. Judgment comes from good judgment comes from experience. Experience comes from bad judgment, right? So like you have to burn your hand on the stove to learn that it's hot. And in any event, I think that was probably the first step and an incremental thing that led me to investing, because here we were able to, we looked at 100 companies, we bought 12, it worked out. I'd been an entrepreneur for 25 years. I had a pretty good feeling for what it took to be an entrepreneur, some of the realities that people might not realize until it's too late. Like there's the perception of entrepreneurship, and then there's the reality. The perception's pretty cool. You read it in TechCrunch. Oh my God, he raised it $1 billion valuation. She raised it a $2 billion value. Oh, this is all so neat. Look at the TV shows, blah, blah, blah. And the reality is you wake up every day and get hit in the face with a virtual sledgehammer, and it's just pain and pain and pain. And
Is
sometimes a glimmer.
Yeah, is that like the 11-year-old kid realizing that you're on the wrong side of the equation, going to the venture capital side?
I think it was more, well, that's interesting. I think here were the steps. So first we bought these companies and they succeeded out of a filter of 100. I moved to Silicon Valley, and I didn't move to Silicon Valley planning to get back into entrepreneurship. I moved there because we had moved to Incline Village, Nevada, primarily for tax and lifestyle reasons, and had realized the schools weren't what we wanted for our kids. So we looked around for great schools. We saw Silicon Valley had great schools. We moved there. But then I saw this tremendous culture of entrepreneurship. So my first thought was, I can help some of these entrepreneurs. And so I thought about being an advisor. I never really pursued that because I sort of had a flawed understanding of what an advisor might look like. I thought about it the way a New Yorker would, which is that I should be paid and I should blah, blah, blah. And that's really just not the Silicon Valley way. It's about equity. It's not about cash. So then later, I started to notice this. I started to think, what about this venture thing? And I talked to some VCs, but everybody goes and talks to VCs, and everybody wants that job. And so that didn't really do much of anything. And then I started to notice this growing gap in the market between angel and venture. So you'll remember that the cost of starting a company between when we started starting companies and even today, but even back then, had plummeted. Like literally one person with a great idea and some Amazon credits, you're in business. And that was not possible before. So I saw that the cost of starting businesses had plummeted. The number of people that wanted to start businesses had increased, but there was this gap. It was the gap between angel and venture. Angel was slow, painful, and small. I wrote one angel check in my entire life. I've been investing for 17 years. I only ever did one angel round, and I did not enjoy the process, and I felt really bad for the entrepreneur. I wrote a check that I was embarrassed by because I thought it was so small. Turns out I was the biggest check in the round, and I was investing alongside literal billionaires. And I'm like, what are you people doing? Is this like you play golf by day and then you do this at night and you bet a couple bucks? So I didn't like that. Too slow, too small. And then venture, people don't realize this a lot of the time, but before the bubble, most venture firms were single-digit hundreds of millions at most. After the bubble, you're talking multi-billion-dollar funds, and you don't grow a venture fund by adding headcount. That takes forever. It's a slow and painful process. So you have to write bigger checks, which meant that Series A's were getting bigger. So in between small angel and big venture were smart people that only needed $1 million. And that at the time wasn't available. And so that's why I started what was then one of the first 3 institutional seed funds around 2007. And that was also serendipitous because I was talking to somebody, a buddy of mine, somebody that had kids in the same school, about what I was going to do next. And I was like, I'm thinking about this, I'm thinking about that, I'm thinking about maybe trying to figure out how to do this investing. And he ran a venture debt shop, which I didn't have any interest in doing debt. And he said, well, we're actually looking for somebody to run our equity practice. And so it was a platform for me to be able to do the investing, learn a lot, put my own money to work as well, which was very important to me, and have upside in my investment. So that's how I formally got started. And then I made a very active effort over the next 8 years to do 2 things: find awesome entrepreneurs and fund them, and get to know tier 1 VCs and learn what they did and how they did it. And because I had been a journalist in parallel, I was a freelance writer for about 10 years. What I learned was you can ask people incredibly hard questions and they will almost always answer them. So when I would have lunch or breakfast or go shoot sporting clays with a VC, I'd just ask them everything. And I cannot remember somebody refusing to answer a question, no matter how deeply personal or highly specific it would have been. And from that, getting to know over 300 VCs, it really helped me calibrate, because you both get to know them and then you look at their track record and you look at their investments and you start to realize who's really good and who's not.
Interesting.
And then that, I think, helps you train your own mind for how to do this at a tier 1 level.
And then that led to you starting your own firm. But I want to back up just for a second, because we met at Jason Calacanis' Angel Summit a number of years ago. And I think it's very interesting to me that you have basically polar opposite styles of investing.
That is true.
Jason's style is to be an angel, first of all, not a VC. He wants to be the #1 angel investor in the world. He's said that many times. But then also more of a spray and pray kind of approach, where your vetting strategy is like, how many companies did you look at last quarter and invest in?
Yeah, so this as an LP, and we're very appreciative of having you for that, because we send out that report. And It was 2,149 companies we saw pitches from, and we funded 3. In 2021, let's say we used to see about 5,000 pitches a year. Now we're trending more towards 8,000. 2021, we funded 9. 2022, we funded 6. I'd like to believe we're going to fund 8, but we funded 3 in Q1 and we funded 0 this quarter, and we're halfway through the quarter. I've got 1 we're deeply into decision-making on. But, look, I have seen the inside data. I've not seen Jason's inside data, but I've seen the world's most famous spray and prayer's inside data. It ain't pretty. I mean, this is a guy who got Facebook and Google and barely made money. So I generally am pessimistic about the model of spray and pray. Now, having said that, I know of at least 2 people that have made a lot of money doing it. I guess the 2 things are... Here's the challenge with spray and pray from the outside. Jason has great access, right? So he has a shot at getting into, as he will tell you 17 times if you meet him, for more than 4 minutes, Uber, right? But you don't.
Fourth into Uber or whatever.
Yeah, exactly. But if you're investing out of, call it Dallas or Miami, how are you going to even get access to that deal? Unless it's been stepped on a bunch of times by a syndicate. So... remember that I said the guy that was famous for creating spray and pray had Google and Facebook. And my memory is his fund was less than 2x. What if he only had one of them? He's losing money. And by the way, Facebook, I think that particular angel got to put in less than 100 grand and never got to reinvest again. So if the world's most famous spray and prayers can only get that in, how much is, the 100th? It's like I play poker occasionally. I'm not great. I'm good, but that's not good enough to play at the real table. The old saying in poker is if you don't know who the chump at the table is,
it's you.
It's you. Well, why are you so lucky to get this deal? You think the founders of Google were looking around for a bunch of random angels to help them out?
No.
So I think it's really, really, really hard because the model is predicated on I just need one. Yeah, but you're not playing the same game. Okay. You might just need one, but if it's a slot machine analogy. Unfortunately, the slot machine with the multi-million-dollar payoff isn't the one you're pulling the stick on. And failure rates in venture, I think venture on average is about a 40% failure rate. That's for highly skilled people. This is all they do. My failure rate is about 33%, which I'm proud of. I'm also sort of confused by it because I invest earlier than venture, but it is what it is. But here's an example. When I was first in Silicon Valley, I did go to some angel group meetings and was sort of generally unimpressed, but I went because it's entertaining. And one of the guys was like, hey, we'd really like you to formally become involved and, put some money to work. I'm like, why wouldn't I just give you money to put into your companies? He's like, oh, you wouldn't want to do that. It's like, why not? I said, well, most of our members lose money. I'm like, so you want me to join a group of people that tend to lose money as investors when the only purpose of the group is to invest? Why would I ever do that? I don't need entertainment. I love what I do. I've done well in the past. I love this, but I also expect to be really well paid for it. The only way I get really well paid for it is by making my LPs a lot of money.
Yeah.
And the only way that happens is when my entrepreneurs do exceptionally well. So, I have the opposite strategy of, and we tell this to our founders all the time, including people that are pitching us. It's like, if we're seeing 8,000 companies and funding 8, we're not interested in the top 1%. We're interested in the top 1 BIP. We want absolute superstars.
How do you get a founder to take the time to pitch to you knowing that the ratio is 8 out of 8,000?
I think hope springs eternal. Look, when you're in the fundraising game, sometimes founders will, when I'm helping a founder raise a Series A, which is a pretty important role for us, sometimes we're like, I don't know if I want to meet with so-and-so. And I'm like, why? And they'll have some reason. Well, he did it. I'm like, okay, you are not in a position where you rule people out. Okay. If there's a 10% chance he's relevant to you, you take that meeting. If there's a 2% chance, you take that meeting. And you don't know what the percentage chance is. You are in the frog kissing game. Okay. Until one of those frogs turns into a prince or a princess, it is not your job to limit yourself. I have a founder. It took them 6 months to raise a Series A. We helped where we could. We got him a check because he wasn't getting one. So we got him a sort of interim check. He finally landed the round, but he's got a spreadsheet of 120 people he pitched. 97 immediate rejections, 32 first meetings, on and on and on.
You have to kiss a lot of frogs.
You got to kiss a lot of frogs because you never know. First of all, you can do all the research you want, but I give you an example. The fact that somebody's invested in something similar could be a negative. Maybe that company sucked. Maybe it didn't work out. Maybe it was nonstop pain and suffering. Maybe it got acquired for 20 cents of the dollar in a talent acquisition. You don't know. So, you've got to just take all those first meetings. It's sort of similar to how I think about trade shows for my entrepreneurs. I say, look, I'm willing to go to any event once. And if it proves itself valuable, I can go back. And if it doesn't, I move on. You've got to put yourself out there. You've got to have the opportunity for serendipity to kick in. You have to give yourself every chance to succeed. By the way, I would say, to the extent people are watching, they're like, why would I ever pitch Ben? We work really hard for our founders. At the end of last year, we had 15 portfolio companies after, call it 18 months. 12 of those 15 had raised rounds at prices beyond us, and 100% of those 12 came from our introductions. So if you make it through the gauntlet, I'm not like with YCs, we're harder than Harvard, which I just cannot stand their. It is what it is. I won't go negative, but we're Professor Xavier's School for Gifted Children. If you think about like the X-Men model, these are superstars, and we will do everything to get them to the right college. Okay, but we are a high school. We're not a college. And our job is to help you get to one of those 327 VCs I know at the top 15 firms when the time is right. And my promise to all my founders is I will help you raise your Series A if I think you're ready, not if you think you're ready. You tell me that 0 to 400,000 of revenue in 2 years with a business that's growing at 20% per whatever, that's not fundable. And you can tell me you think it is all you want. I'm not going to sacrifice the chance to have all my other great founders get the meeting the same day when I need it, because I pretended you were ready. So we're a little, yes, I'm a harsh parent in that way, but we've helped a lot of people do a lot of great stuff.
Yeah, sounds like it. Well, I'm an investor in Tenacity, so I'm all for, you accomplishing that. We have a little friendly wager on which fund is going to outperform 10 years from now. Well, let's see who wins that dollar. Yeah, exactly. But what else do you think startups should keep in mind when working with or searching for an investor?
So, the number one thing I say to entrepreneurs is once you have the opportunity to work with somebody, you really need to do your diligence on that person. Now, everybody says they do. Most of them don't. My number one tip is first you get all their references. Who did you invest in? Who should we talk to? Then you do your searching on Google and LinkedIn and you find out who they didn't mention and you call those people. Because it is important to understand how people act in the hard times. I have been on boards before where people were not good actors and it had material impact on the companies. And I've been on boards where people were the difference between success and failure. Now, no matter how much an entrepreneur is told by an investor that they're going to be there for them, an entrepreneur gives up their whole life to be an entrepreneur. Work-life balance is a myth for entrepreneurs. If you want work-life balance, I'm not negative, but don't bother to go into this game. Like I'm sure IBM's got a role for you or whatever other big company. But in the world of entrepreneurship, it is all consuming. And so there is no investor on the planet that's going to be there for even a single digit percentage of the time that you're going to be in. Now, they should be available to you when they're needed. They should be able to give you trusted counsel. They should be people you trust and respect. But, you have to be as careful as you can. Look, sometimes you don't have a choice. I had a round I did where I only had one bidder. Guess what? That's whose money I took. And boy, did I regret it later. But I had no choice. It was that or don't go forward with the business. So I think I literally had a banker helping me, which is generally not a good idea, by the way. And I said to him, look, I don't care if you have to bring Lucifer from hell and have me sell my soul. I need the money to get this business going. I need to be able to keep going. I was being literal. I don't actually believe there's a Lucifer to come buy my soul from me, but that.
Yeah, did you sign on the bottom line there?
Yeah, it's cut the blood. But it wasn't as bad as Lucifer, but it wasn't a lot of fun, man. I had a really painful process after that, and that's why I'm so fanatical about helping my entrepreneurs pick the right people. Now, I don't always know the answer. I know the answer on probably 327 people, but I don't know the answer on all of them. And there are new people all the time, and I try to get to know them. But your network is important, but your recency is important too. And if you have, one of the things I've learned the hard way is you can have 6 lunches with somebody. If you haven't been in a deal together, you don't know each other. You don't know how they're going to act when the world falls apart, COVID hits, and they're scared that their businesses are going to be destroyed. You don't know how much pressure they're going to put on their founder to make illogical decisions, or how much support they're going to give when their founder makes a logical but difficult decision. It's just entrepreneurship is hard. And the vicissitudes of entrepreneurship are like the classic roller coaster. although they have a lot more downs than they do ups. And sometimes often those downs are entirely unexpected. And when you've got a panicky board member, I have a company that I won't mention it by name because that's not fair, but they sold for close to $1 billion. It should easily have been able to add a zero. Company should have gone all the way, should have been public, should have been worth quite a bit more, absolutely dominant in its category. Why did they sell? Took money from the wrong guy, and the founder could not stand that human and did not want to, and finally was like, I cannot spend another day. I'll take the bid. Billion's fine. I'm out.
Wow.
Right? Like that, you can
I've seen that,
destroy value by having the wrong parties. And you can add material value. And I'll tell you a story where somebody got the opposite story. I won't be exact, but I was trying to help an entrepreneur understand the reality they were involved in a transaction, and they were not willing to hear the story. But the other investor basically gave them a term sheet that reflected the story I told. And based on that, increased the price of that acquisition by about $1.5 billion. The founder owned 20% of that company. That founder made an extra $200 million because a board member stepped up and gave him a term sheet that gave him the gumption and backup and safety to go push for that higher price.
Interesting.
Huge win. I don't think he understands that he's got almost $250 million in his pocket today because one guy stepped up and gave him the courage he needed to have.
Well, since you do have such a narrow filtering process, what are the primary things you're looking for? How do I make that short list of 0.1% of startup founders that get funded by Tenacity?
So I have, over the last 17 years, come up with more and more pithy little sayings. And one of them is I need 5 things to make an investment. You might have heard this before. People, a great idea in a huge market if it works. The hardest thing actually is usually the last one because they're really great people. It's interesting. There's been a lot of, I've done a lot to create access across all groups. Like I fundamentally have no concern with your school, your background, your gender, your race, your political, none of it matters. I need you to be smart, tenacious, and driven. But regardless of where you come from, the chance that your idea can move on to be what I prefer, uncapped upside, a future public company with no limits, that's a small sliver. And a lot of entrepreneurs that pitch for venture don't get that they are pitching, I'll give you an example. I once, do it this way. So I created this thing I call the Ben rule because I was always jealous of Moore for having Moore's law. And it's like, if you take what you need, not want, but what you inside need to consider yourself a success, put a dollar amount on it. That's the number you're going to say yes to. When someone comes to you and says, I will buy this for X, that number is the number where you just now are like, that's my number, right? That's the number that makes me the big dog at home. That's the number that makes my mom proud. That's the number that fulfills all my dreams for philanthropy. Whatever. I don't need to know your motivations. Okay, you figure out that number. Divide it by 5. You should never pitch a fund that's any more than that number represents more than half their fund. If your number is $50 million, let's make it $100 million. Okay, divide by 5, that's 20. You better be pitching a $40 million fund because every VC investment needs to have the chance to return the fund or to bare minimum be material. I need to believe so one of my LPs in New York, we were sitting down over lunch and he asked a classic old school question. He was an older guy and he's like, so Ben, which company is the fund returner in this fund? And I was like, I only invest in companies I believe can be fund returners. We have 15 companies now, and I still believe in the thesis of 12 of them. Does that mean I have 12 fund returners? No, that's never going to happen. But I still believe they all have a shot. So I don't have that answer. I have the answer that 12 of 15, I'll tell you this, 3 of them aren't. But, so you've got to believe they can be fund returners, hopefully fund returners in multiple, because that's the only way economics work in venture.
So Ben, we had you at our demo day event yesterday. We run a venture studio and we've known each other for a number of years. So I'm going to put myself out there and just ask you what you thought.
I think you guys did a great job. Guys being gender neutral, your team.
Yeah.
I see, as you know, we see 8,000 pitches a year. We do demo days ad nauseum. I'll tell you, it's very rare these days that I'm at one in person, and I do prefer that. But you'll be like one of 6 demo days we'll see in person versus the hundreds that we see online. What I was really impressed by was the quality of presentation. Irrespective of the opportunity, these entrepreneurs were clearly trained and coached to get what they needed to get done. They were clear and concise and did a great job of presenting, gave me all the information I needed, and that is extraordinarily rare. I have been to, I mean, it is one of the, I do something for my founders called Deck Doctor. I think you know this, where when they're ready to pitch for Series A, we will spend on average about 4 hours just micro-analyzing their deck. And usually it, you know, like I had one founder, I was at an event and he came over to me 4 times while I was talking to someone. You got to have Ben tell you about Deck Doctor. He got us down from 32 slides to 8 and we raised 26 million on 100 and he gave us the messaging and it's because of him we raised it. Now the reality is because the team was awesome and the business was great, but your team and you clearly did a great job of helping these entrepreneurs do their presentation concise, accurate, and within the time allowed. And that is an enormous gift. It takes so much time for someone to do a short presentation. It's the old Benjamin Franklin, like, I'm so sorry this letter's so long, I didn't have time to write you a short one.
Yeah, exactly.
So huge gift to them. Great job for you. That alone is so much value add that, you know, everything else is icing. So no, I thought it was really well done. There was at least one company I liked and considered following up on, which concerned there were 14. 1 out of 14 is actually world
I like
class.
those odds, but for you to say that, I think that's fantastic.
Yeah, no, you did a great job, and I think you should, you know, be given an enormous amount of credit for it, and entrepreneurs should understand it. Because they get, you know, there was an accelerator that just went out of business, and
Yeah,
they were, you know,
Chip.
basically talking about all the things they said they do that they didn't. And, you know, you can never raise money for a founder. No founder should ever believe that anybody can go out there and get them money. What you can do is help them become the absolute best at telling their story and open doors. And if you do those two things and they have a business that justifies it, they should have an unfair advantage to win. But they still have to walk through the door and close the deal. I had a VC actually tell this to me once because I connected somebody and he totally fell on his face. And he's like, Ben, all you and I can do is open the door. It's up to them thereafter.
Exactly.
And that balance is also an important thing for entrepreneurs to understand. You can give them the tools, but you cannot make them the house. They have to build their own house.
That's 100% right. And we try to hammer that in. Some of them hear it, some of them don't.
You can only, intelligence versus wisdom. There's a huge spread.
Well, congrats on raising your fund so quickly. That was your first fund for Tenacity, right? And I think you raised in, what was it?
We raised half the fund in 25 days and the rest of it in a quarter.
Wow.
It was supposedly a land record.
That is a nice
for that.
pace. Well, good luck on your next fund. Thanks for coming on.
Thanks for having me.
So, Ben, I don't know. I think you know by now I like crazy socks. I've got my caffeine molecule socks on today because I needed some caffeine this morning. And I appreciate you coming on. I've got some wine socks from you because I happen to know that you do like some fine wine once in a while. I've been at some of your events, and so I think you're actually a sommelier, aren't you?
I am a level 1 sommelier. It doesn't take a lot to get that, by the way, but you know, it took a weekend. By the way, you did a great. The wines you had at your event were great.
Oh, okay.
I was
great.
impressed. You'd be amazed at how many venture-related events you go to, and you're like, you picked these wines? I
or
wanna,
the food, right?
Yeah, exactly. I saw your food was awesome. I want to, like, it's my open invitation to anybody I know anywhere in venture. If you're going to do an event and you're wondering, I'm more than happy to help you for free to make sure you have better food and wine so that I can eat and drink it. Because sometimes you show up at like a tier 1 venture firm and you're like, this is it? What did you like reach out to Costco to get this catered? Sorry, pet peeve, but thank you for these.
Yeah.
Excellent.
Absolutely.
And thanks for having me on. This is a great setup.